Hello, this is My Time Television covering United States stocks. This video is co-broadcast with Mijun Television. This time we'll continue with the Wise Investors Shopping List segment. So far, I've talked about 4 stocks, and from now on, during this segment, I'll review 2 stocks at a time, focusing on current blue chip stocks and those that have gained a lot of attention in the market due to their recent rise. Basically, this segment is being done with the market correction in mind. Recently, the market seemed to be correcting, then it went up, but on Friday, it experienced a significant correction. With this kind of volatility, personally, I still believe that the possibility of further correction is high. So until the correction seems to be ending, I plan to consistently look at 2 stocks at a time with you all. In the meantime, if there are any particular stocks that drop sharply, or if some stocks reach a good timing as mentioned before, I will mention them again. Today I will reveal 2 stocks. Although there are logos in front, the companies are Cadence Design Systems and Synopsys. The reason I group these 2 companies together is because they are actually competitors in the same business. These companies are called electronic design automation companies, and when we produce semiconductors, we need to use various systems and semiconductor programs. They sell software that provides these kinds of very basic programs. So once you set up the basics, these companies provide software with basic programs already set up to some extent, which can significantly reduce the time needed to design semiconductors. So these 2 companies are competitors, and although their sales sizes aren't that different, together they account for over 70% of the market share, making them oligopolistic companies. Also this year, Synopsys acquired a competitor called Ansys, which was a bit smaller than them, and as a result, these 2 companies have essentially entered into an oligopoly. So, as semiconductor production increases, these kinds of companies also benefit. And they're in that kind of position. So let's compare the 2 companies and take a look at where they stand and which one is currently more attractive. Let's move over to choice stock and take a look at each stock one by one. First, let's take a look at Cadence Design Systems. Yes, looking at the signals here, the current AI trading signal says hold, and recently, yes, the signals have been. Han Hyojung, yes. There was a sell signal on November 6th and then a buy signal on December 4th. Right now, it's down about 3.8%. Since it dropped 3.6% last Friday, basically, the loss on that day is almost negative. So after the buy signal, it hasn't been long, and currently we're seeing a slight loss. Is that right? Let's consider 3 questions. Is it a good company? How will it perform in the future? And what about valuation and supply-demand factors? Let's take a look at the diagnostic scores. Cadence Design is ranked 13th among all listed United States companies, making it a top-tier stock. And even if you look at this pentagon-shaped graph, the future growth score is 65, which is quite high, and the rest are all scoring 90 or even 100. So in terms of being a blue chip stock, we can view it as a top blue chip stock. You can look at the financials and everything with this information, but since all the data has already been checked and scored, you can tell how much of a blue chip company this is just by looking at this pentagon. You can basically just consider this company a top-tier blue chip stock. If the growth score is over 70, that's best, and 80 is even better. Of course, if it's 65, the company is growing, but it feels more like it's in the middle range. So if you look back and compare it to the past, last year it was 83 points, but now it's 89, so it's gotten better. Yes, the score was low in the middle, dropping to 81, but in the last 3 or 4 months the score has gone up again. Recently there's been a turning point as the company moves toward becoming a better business. If you scroll down, you can see our analysis of 5 factors: growth, monopoly power, finance, safety, etc., and how each has changed over the past year. If you look at the growth score, it was 55 points a year ago, but as of this past August, so about 4 or 5 months ago, it dropped all the way down to 25 points. So the growth score dropped, but then it jumped up and has been maintaining around 65 points. What this means is that growth was declining, but recently future growth potential is increasing, so we can see that things are moving in a better direction. So, the score we're analyzing includes not only past data but also projected earnings per share growth rates and even revenue for the future. That's why the improvement in growth reflects the expected future performance as well. You can think of it that way. Monopoly power and financial stability are both 100 points, while profitability and cash generation are 90 points overall. It's very strong in these areas. Only the growth has dropped a bit, but since it's been recovering recently, I think it's definitely worth paying attention to. Next, now that we're here, we need to check the consensus data to see how the future performance will be. If you look down here at the bottom, you'll see sales and earnings per share. This part is the consensus. So, the dark blue color for sales is the confirmed performance, and the faint gray color on the right is the expected performance. So, if you look at December 2025, compared to the past, the sales growth is 14, 13, 12. So 13 and then next year it's 12%, and the year after that it's 12.8%. So you can see that this company has a steady average annual sales growth rate of about 12 to 13%. Then, why did the growth rate decrease or increase? Since sales barely changed, this likely didn't impact the score. Look at the earnings per share below. In 2023, earnings per share growth was 23%, then dropped to 0.7% in 2024, and is projected at 1.6% for 2025, so earnings per share growth lagged behind sales growth. But why has the growth score recovered now? Right now, as we're filming, it's mid-December 2025. But the projected performance shown here is from the end of December 2015, so that's actually over. The market cares more about the data from December 2026. So if you look at the data for December 2026, which is next year, the earnings per share grows by 37%. And the year after that, it grows by about 16%. Then, compared to the past growth rates of 0, 79, 1, and 6, you can see that the company is transforming into one with much better earnings per share growth. In other words, much better profitability. So with Cadence design system, rather than looking at past stock price movements, we can use the projected data to see that the stock price movement over the next year could be much better. Now let's take a look at the valuation as the second point. For valuation, just click on the second tab here. If you click on valuation, if you look at the data from the past year for this company, when it's overvalued or undervalued, this solid line here represents the fair price. And usually the price moves up and down between these ranges. Then, if you look at the data from the past year, this point where it fell below the fair price, if I point it out on the graph, it's this point. So the undervalued point is at the very bottom and the fair price is in between, so it's in the middle. If you look at it, it's hitting the lowest price in the past year. And I checked by extending the data to 3 years and it's the same there. At that price range, historically, it's a really cheap price. And those times above are when it was traded in the overvalued range, but now, after a correction, it briefly dropped below the fair value, rebounded, and now it's starting to turn down again. So in the long term, when it reaches this kind of price range, that's the most undervalued area in terms of valuation. In the future, this is what it looks like when the current performance is reflected, and as this company's results continue to be reflected, it will keep going up. In the case of Cadence Design, we are doing our own valuation based on earnings before interest, taxes, depreciation, and amortization. Our calculations show it's expected to grow about 15% per year on average over the next 2 years. So currently it's $310, but this means it's growing by 15% each year. So 1 year from now, it will be about $356, and 2 years from now, about $400. In other words, it's in the middle here. Lan after that, it goes to $400 like this. Then the value above will also go like this. It will be drawn like this. Sorry, I exaggerated a bit, but it will be drawn like this. then the areas I'm marking with stars right now would be considered the best price ranges, right? These areas, should I shade them in? These areas become the best prices to buy. So if the stock price drops and comes to this price range, I think you'll be able to buy it at the cheapest price from the company's perspective. If we look at that price range roughly at this point, it's about 200. The $255 to $280 range is the most appealing price-wise. But if this company continues to show good growth and the supply-demand trend remains strong, it won't drop to that price range in a short period. Instead, just like at this point, it will likely move up and then come down gradually like this. That's why I always say after reviewing the valuation, we should check supply and demand. Next, third, we're also going to take a look at the supply and demand. If you come to the first screen and look at the supply and demand exponential moving average here, you'll see that the supply and demand situation is currently experiencing a lot of volatility. If you look at it as a short-term signal, there's been a lot of movement back and forth in this range. Around November, it switched to a bearish trend, meaning it turned into a sell signal, and then it dropped sharply. As the stock price surged, the 5, 21 and 61-day moving averages clustered together. Between the mid-320s and $330 within a $5 or $6 range, they are closely grouped. The stock is at $323, so the current price and the 5, 21 and 61-day moving averages are all clustered. So at this point, they are completely packed together. If the current price moves in one direction, it's likely to expand in that direction, which is what we call divergence in stock prices. There's a high possibility of that happening. So right now, Cadence Design Systems is at a very important point in terms of its stock price direction. So right now, the stock price is going through some corrections around $323. Even if the index drops from here, if it holds up well and quickly rises above $330, it will have a much better trend. Since there's currently a holding signal, the signal will probably continue until it's time to sell. If it breaks below the $320 level here, and then we look at the midterm signal, has a midterm sell signal appeared here? For the first time recently, we're at a point where we're getting stuck, and the midterm, slightly longer term direction is about to be decided. If you look at these price levels, they're 325, 327 and 328. Right now it's at 323, so breaking through around $330 quickly would be really good for this company's supply and demand situation. If it breaks below the $320 range and starts to fall to the $310 range, the midterm market signal could get a bit tangled, triggering a sell signal and possibly leading to a longer adjustment period. So right now, I can't say definitively which direction it will go, but if it does break in that direction, I think it's best to be prepared for a correction down to the price range I mentioned earlier. If it breaks through $330 in a short period of time, currently there is a buy or hold signal, so I think it's best to keep watching until it turns into a sell signal. So that's how you can look at the Cadence systems. The second company is actually a competitor, but it's the same type of company, switched mode power supply. Let's take a look at Synopsys. Yes, Synopsys also has a current signal, but the signal is minus 2.8, so it's not good. It's not good. Did this company also get a buy signal recently? Earnings were released unexpectedly, causing a gap down and resulting in significant losses. Currently, although a buy signal has appeared with rising prices, volatility remains high. If you look only at the position, just from the perspective of the exponential moving average supply and demand chart, it's showing movements very similar to Cadence Design System or Synopsys. Then let's take a look at the diagnostic score. If you look at the diagnostic score, it's a bit similar to the Cadence Design System you saw earlier. Because if you look here, this company had its financial stability here last year. You can see last year's score in the background next to it like this. You can see that it's shrunk now, so it has dropped a little. But the problem now is that the future growth part here is a bit higher than in the past, but it's lower than Cadence Design Systems we saw earlier. So if you look only from the perspective of growth, Cadence Design System is being evaluated more favorably than Synopsys. If you want to invest a bit in growing stocks, you could say Cadence Design is superior to Synopsys. Synopsys generated around 6.4 billion in sales over the past 4 quarters. Cadence Design earned 5.2 billion. But in terms of operating profit, Cadence made $1.48 billion and Synopsys made $1.1 billion. So Cadence Design System is much more profitable. So Synopsys has a return on equity of about 21%. Cadence has about 21% and Synopsys has about 14%. So in terms of profitability or shareholder return so far, Cadence Design Systems is a bit ahead. That's the situation we can see, right? Now, if we go back to the company's consensus, its score is relatively low, but in terms of being a blue chip stock, it's definitely a blue chip. However, in terms of growth, it's a growth stock with less growth than Cadence. So we can summarize it as a blue chip with moderate growth. If you look down at the bottom, there is consensus data. If you look here, the sales revenue for October 2026, since October 2025 has already ended, it will be changed to the final confirmed results. Looking at this data, in previous years, the sales revenue was 15, 15, 15. It's not much different from Cadence Design Systems earlier. Cadence had 13% like this. But then in 2026, it jumps 38% unexpectedly, only to fall back to 10 in 2027. So what happens before October 2026 to cause this sharp increase? That's what I'm wondering. As I mentioned at the very beginning, they bought a company called Ansys. So because they merged, the revenue from that company will be fully reflected up to October 2026. Since the revenue is added here, the total revenue looks really big. So I wouldn't say you're being deceived, but you shouldn't misinterpret the data. So at this point, it looks like it increased by 36% because it's combined, but the next year it drops to 10%. If you look at the earnings per share in 2020, revenue increases by 38%, but the earnings per share actually decreases. Then the following year, the earnings per share increases by 81%. It's strange, isn't it? So revenue increased by 10%, but earnings per share increased by 81%. This happened because the previous year, 2016, was relatively low. In October 2016, revenue was up by 36%, but earnings per share actually decreased by 28%. Cases like this are also quite rare. So it's important to check why this happened and why it won't happen again in the future. In those cases, even if it's a hassle, we have no choice but to look at the financial statements. If you click here, you can figure out the reason for this company. If you look here, it says the company's non-operating income. In the past, non-operating income was about $100 million, but suddenly it increased to $1.1 billion into the billion-dollar range. So it made the net profit look really big. Net profit is operating profit plus non-operating income minus financial costs and corporate tax. So the net profit appeared to be much higher. Recent performance figures increased for this reason. The question is whether this will continue, which we need to examine. Then let's first check if this is a recurring profit and if it's still happening in the recent quarters. If you look at the operating profit, it's suddenly going back to how it used to be. The most recent quarter was 1.7 billion. The previous was 1.1 billion. The exception was October 31, 2024, with 8.6 billion, totaling $11 billion. Then for next year, meaning by October 2026, it's very likely that this kind of $800 million event won't happen. So what was that $800 million? You can only find out through things like the electronic disclosure system or searching for news articles. So when I looked it up, what happened was that this company sold one of its business divisions. By selling this division, the company brought in $820 million. So when I looked it up, it turned out to be healthy. This is how you can use it. I found out it's not that, but last year, in other words, the profit from the sale of the business unit that occurred up until October 2025 won't occur in 2026, and that's why this happens. So the earnings per share dropped sharply, and this is something you shouldn't pay attention to. I can summarize it like this for you. And I mentioned that this company acquired a company called Ensys. When they make the acquisition, here's what happens. If you look at this company, its borrowings. If you look here, as of January 2025, the company only had about $660 million in borrowings. But if you look at the most recent quarter, it's $15.1 billion. So how much did it increase? Borrowings rose by about $14.5 billion. If you click below, you'll see capital stock and capital surplus. These are from issuing shares. When shares are issued and the money comes in, it's recorded there. If you look at this too, in the past, it was about $200 million, $500 million, or $300 million. But suddenly, in the most recent quarter, it's $17.9 billion. So if you subtract $500 million, about $17.4 billion came in here as well. $17.4 billion came in, and borrowings also increased by about $15 billion, so roughly $32 billion in total. The company raised funds, right? They must have used this money somewhere. Where they used the funds is recorded in the asset section. So if you look further down, you'll see that there's something in the assets that has increased significantly. If you look above, you'll notice cash has dropped significantly because they spent what they raised. So what went up? If you look at intangible assets, last quarter it was $3.6 billion, but it suddenly jumped to $40 billion. That's an increase of about $35 or $34 billion. Most of the time, intangible assets increase like this when a company does an M&A. So you can see that the M&A of this company is reflected here. Then you should remember that I mentioned earlier about acquiring a company called Ensys. So you recall that they bought Ensys, and this company took out loans, withdrew money, borrowed money by issuing shares to shareholders, and raised about $33 or $34 billion that way. So we can see that they went all in on the M&A to acquire Ensys. So the amount of money this company invested to acquire Ensys is about $35 billion. So the amounts pretty much match up. That's how you can look at the financial statements like this. Since this company incurred this debt, if you look at the financial expenses for this quarter, 2 quarters ago it was $94 million. This is the interest expense. The financial expense is now $140 million and will likely increase further. So this financial expense will be at least about $150 million per quarter, and this will have the effect of reducing net profit a bit more. So while the profits generated by Ensys will be combined until the borrowed funds used for this acquisition are reduced, it's better to think that financial expenses will increase a bit. And even if you look at the stock price earnings per share chart below the stock price, in the case of this company, it has hardly been able to break out of what you could call a box range. It struggled because the earnings per share has kept dropping. Now, we need to look at how things will recover in the future, and as I showed you earlier, it's around 2026 or 2027 when the earnings per share will start to recover in earnest. And if we take a look at the valuation, this one has always been undervalued, just staying at a fair price or undervalued for years, and it's still moving in that pattern. So in the case of this company, it's currently very undervalued. And if it's very undervalued, it's good to buy, but then you need to look at the supply and demand. Even if it's cheap, it could drop more. If expensive, it could rise further. You must consider supply and demand together. So the valuation is fine. If you look down here, it broke and kept falling. Recently, the stock price has been going up a bit in the short term, so it's about to become volatile. But the 5-day moving average is $464, and since the current stock price is $452, it's in a slightly bearish arrangement. It's very important to break through $464 quickly, and in the midterm, there's still a long way to go for a recovery. If you click on the midterm here, you can see it's been dropping steadily from the top. The 120-day moving averages are mixed at 475, 453, and 444. So until it completely breaks through $470 and $475, it's not easy to say that the midterm trend has reversed. So right now, it's in a state where it's trying to make a change in the short term, but in terms of supply and demand, it's not a complete change yet. So I think it would be better to watch this change a bit more before making a judgment. To sum up, if you look at Cadence as a company itself, personally, I think Cadence Design Systems is a bit better, but in terms of valuation, Synopsys is definitely trading much cheaper than Cadence Design Systems. And from a supply and demand perspective, Cadence Design seems to be a bit ahead and is showing some signals. Actually, it's more likely that Cadence will move first and then Synopsys will follow. On the other hand, if Cadence breaks down and goes downward first, it's much more likely that Synopsys won't be able to go up either. So I think it's better to keep that in mind. So please keep those things in mind. And if you set up alerts for the trading signals and information we provide, you can receive them as push notifications once a day. I hope checking those will help you make your final trading decisions. Thank you for watching.